Today we will discuss where you should invest in direct equity or mutual fund, or in both equity and mutual fund. First we will do a comparison of direct equity or mutual fund, then finally we will conclude where we should invest. Equity means directly buying the shares from the stock exchange through the broker, and mutual fund means you have to invest in particular scheme of particular mutual fund company, and that mutual fund company further invest into the equity shares of the multiple companies. In direct equity you will require a demat account to trade the share and invest the share, whereas in mutual fund you do not require any demat account to invest in the mutual fund. When you invest, what are the charges are involved? So in direct equity there are a lot of charges like stamp duty, transaction charges, STT, brokerage. These are the various charges charged when you invest in the equity shares. But in case of mutual fund there is only one charge which is very negligible, 0.005% of stamp duty, no other charges. Charges when you sell the units, transaction charges, STT, DP charges and brokerage. Here there will not be any stamp duty on selling the equity share. In case of mutual fund there is only one charge which is called as exit load. Now annual fees. In case of direct equity, broker normally charge the demat account charges, which is normally called as a AMC charges. And in case of mutual fund there is a expense ratio which normally mutual fund charge for as a fee, which normally ranges from 0.1% to 2%. Investing directly into the equity, you will not require any fund manager. In case of mutual fund you will require fund manager who will invest on your behalf. So here fund manager will require. Risk involved, as you are investing directly into the equity, so there will be a less diversification because you will not have that much of money to diversify a portfolio, and as a result the risk will be more. And in case of mutual fund the risk will be less because fund manager and mutual fund company collect the money from the various investors, so they will be having a lot of money to invest. So if one or two share doesn't perform, so it doesn't affect the portfolio of the shares. So here the portfolio will be less risky as compared to direct equity. Time and expertise. You are investing on yourself, so you will require a research time, expertise to build your good portfolio. In case of mutual fund, there is a professional fund manager which will help us to building our portfolio. Now the cost of investment. So in direct equity there will be a high cost of investment in two terms. First, we have already discussed that there are a lot of charges like STT, stamp duty, transaction expense, which makes your portfolio very expensive. In case of mutual fund, you can start the SIP with 500. If you invest in just Nifty 50 index fund, by 500 rupees you will get 50 shares, but it is not possible in direct equity. By investing 500 rupees you will not be able to get 50 shares. Hardly you can get 1 or 2 shares, so which makes direct equity expensive, whereas mutual fund make affordable investment. Now control. Now since here you are managing your portfolio, you have to make more control on stock picking, stock selection, and continuous monitoring is required on your portfolio. But in mutual fund, since the fund manager is picking the stock, holding stock, so no monitoring is required, they are taking care of on your behalf, and for that they are charging the fees, which is called as expense ratio. Now volatility. Definitely the volatility will be higher in equity because you are having a less basket of share, so volatile will be your portfolio will be more volatile. As a result the risk will be high. And in case of mutual fund there are multiple stocks in the portfolio, so there will be a less volatility, and as a result the risk will be less. Now tax benefit. In case of direct equity there will not be any tax benefit you will get when you invest in the shares, whereas in mutual fund if you invest in a ELS, a tax saver scheme, you will get the deduction under section 80C, which will help to reduce the tax. So these are the comparison points. Now finally we will discuss where you should invest. So first point, equity investment. All investor must invest in equity because you will get extraordinary return which will help us to build the wealth. See, in mutual fund what happened, you will not get extraordinary return. When you invest in stock, so it will perform 20%, 50%, unlimited chances of performance, whereas in mutual fund there are basket of stocks. So what happens, some stock doesn't perform, some stock perform. So the NAV will be adjusted and will not get extraordinary return as compared to directly investment in equity. You will get decent and good return in mutual fund. So for getting extraordinary return, you should invest in equity, and for decent return, you should invest in mutual fund. So in now conclusion, you should invest in both for getting all type of return, extraordinary plus better return. So your portfolio will be balanced. Now you should always look for mutual fund SIP not for a shorter period but for a longer period, around 10 years, 20 years, 30 years. More the horizon, more will be help us to get the rich in the future. Now you can also explore the, apart from equity investment, equity trading also you can do, which will help us to get the side income, which is also called as an additional source of income. Now when you invest in direct equity, you will get the ownership of the company. When you invest in the stock, you will get the owner of that company, whereas it is not possible in mutual fund. Since mutual fund company is investing, so mutual fund company will become the owner. You will not become the owner of that company. By investing in equity, you will get the direct dividend from the company itself. In mutual fund also you will get the dividend, but which will be decided by the mutual fund company, and that is not actually handsome dividend. But when you invest in the dividend yield company, good dividend yield company, you will directly get the dividend, which is very good dividend. So this benefit is included in equity, directly good dividend from the company, whereas in mutual fund you will not get direct dividend from the company, but you will get indirectly from the mutual fund companies. By investing in equity share, you will also get the benefit of bonus share. When company declare the bonus share, you will get the benefit of that. You will not get benefit of the same in mutual fund. You will also get benefit of right share. When company declare right share, if you hold the that company's whole share, you will get additional right share. Then stock split benefit also get. So these are the benefit of directly investing equity. Bonus share declaration benefit, you will get right share, stock split, which is not actually available in mutual fund. So in and all, we can compare and we can say that you should always invest in direct equity for extraordinary return, and mutual fund to get a decent and better return. So you should proportionately invest in direct equity as well as in mutual fund, depending upon your budget and risk appetite. I hope the video is useful to you.